Welcome back to the deep dive. Today we're digging into something really crucial if you follow the tech world, the CFO's opening remarks from a major tech company's Q3 2025 earnings call.
Yeah, these remarks are particularly interesting this quarter.
Absolutely. You sent us these sources because, well, you need to get past the AI hype and see the actual financial plumbing, right? Our job here is to pull out the key numbers, see how the core business is doing, and maybe most importantly, understand the scale of these massive infrastructure bets they're making on AI's future.
hmm And it's crucial because these remarks lay bare this fundamental tension in big tech right now. You've got this picture of really strong performance today.
Yeah, they're talking about maintaining, what, a 40% operating margin?
Exactly, around that level. But at the same time, they're committing to this. This just unprecedented spending on infrastructure for tomorrow.
It sounds like a real balancing act.
It's the ultimate tightrope walk, really. How do you keep profits high today while investing so much in compute for the future that you know it's going to hit your margins pretty soon? This is where strategy gets real, where it turns into actual dollars and cents.
Okay, let's get into those Q3 results then. The scale is just mind-boggling sometimes. The community, the family of apps, still growing.
Still growing. Over 3.5 billion people. Think about that. Using at least one of their apps daily back in September.
Nearly half the planet. Wild.
And that scale, well, it obviously feeds the top line. Q3 total revenue hit $51.2 billion.
Wow.
Which is up 26% compared to last year. And almost all of that, $50.1 billion, came from ad revenue in the family of apps, also up 26%.
Okay, 26% growth. That's strong. But what's driving that ad revenue growth? The CFO broke it down, right? It wasn't just one thing?
No, not at all. It was really a dual engine, as you said. Two things happening together. First, just more ads being shown. The total number of ad impressions served went up 14%.
Right, just sheer volume increase.
Volume. But second, and this is key for the bottom line, the average price they got for each ad also went up by 10%.
Okay, so more ads and more expensive ads.
Exactly.
Yeah.
And that higher price tells you a couple things. One, advertisers clearly want to be there. Demand is strong. And two, their ad systems are actually working better, delivering results.
Which is impressive because they're also growing in places where ad prices are typically lower, right? So they're overcoming that headwind.
Precisely. They're managing to get smarter, more effective, even as they get bigger globally. It's quite the achievement.
And we should touch on the other revenue streams quickly. The family of apps, other revenue, $690 million. That jumped 59%.
Yeah, that's mainly things like WhatsApp paid messaging, Meta-verified subscriptions, those premium services. It's still small compared to ads, obviously, but growing that fast, it's just these could become pretty meaningful down the road.
Okay, revenue looks solid. Now let's flip to the other side, expenses.
Yeah.
Because you said this is where we start seeing the shadow of 2026.
This is where this story really starts to shift. Q3 total expenses were $30.7 billion. Now that's up 32% year over year.
Hang on, revenue up 26%, expenses up 32%. That gap, that's not ideal. And you mentioned expense growth accelerated.
It did, by 20 percentage points compared to Q2. That's a big jump in the rate of spending increase.
So what caused that sudden spike?
Well, the CFO laid out three main reasons. First, there were higher legal costs booked in Q3, one-off charges, but they hit the quarter hard.
Okay, legal stuff. What else?
Second, paying people more, specifically accelerating compensation growth because they're hiring a lot of technical talent. Think AI experts, that's expensive.
Right, the talent war for AI.
Exactly. And third, and this is the big one looking forward, infrastructure costs are ramping up faster. Building out data centers, depreciation hitting the books from past spending, and using more third-party cloud services too.
So they're already paying heavily for the AI future.
So absolutely front-loading those costs. You see it clearly in the Q3 numbers.
Got it. And one more thing before we move off the financials, that tax rate, 87%. That number just jumps off the page. You look at that and think, catastrophe. But it's not quite real, is it?
No, it's definitely an accounting quirk.
Why?
A very large one, but still a quirk. It's tied to new U.S. tax law and something called a non-cash reduction in deferred tax assets.
Okay, let's translate that for, normal humans. Non-cash reduction in deferred tax assets. What does that actually mean for the cash register?
Right. Think of it like a big bookkeeping entry today that doesn't involve actual cash going out the door. But because of that accounting move, they actually expect lower cash taxes later this year and in future years under the same law.
So it hurts the reported profit now, but helps cash flow later.
Pretty much, yeah. If you strip out that charge, the underlying tax rate for the quarter was actually about 14%, much more normal. It's an important distinction affects the accounting, not the core cash generation.
Okay, that makes sense. Crucial context. All right, let's shift from the money to the engine driving it, the product itself. Because AI isn't just a future plan, it's boosting the core business right now. How's engagement looking?
Really strong. Global time spent was up on both Facebook and Instagram in Q3. And get this, even in a mature market like the US, time spent on both platforms grew by double digits year over year.
Double digits in the US, that's significant. What's driving that?
Mostly video, especially Reels.
Hmm.
The recommendation systems are just getting better and better at figuring out what you want to watch.
Yeah, the CFO mentioned Facebook is surfacing twice as many reels published that day compared to the start of the year. That suggests the AI is getting much faster and more relevant.
It really does, and that feeds directly into their 2026 product plans. A big focus is making those recommendation systems even smarter. They want Instagram, for example, to show you content across a wider range of topics, not just stuff you already follow or like.
Broadening horizons, basically.
Kind of. And behind the scenes, technically, they're building these new, huge foundational ranking models. These will use vastly more data and, crucially, more compute power for training next year.
So connecting back to the spending, the AI talent hires, the data center build out that's all needed to power these bigger, smarter models.
Precisely. You can draw a direct line. They need that talent and that infrastructure to really leverage things like LLMs, large language models, to get much better at understanding content.
Content understanding, meaning?
Meaning being able to precisely label what a video or a post is actually about the keywords, the topics. If they know exactly what the content is, they can match it perfectly to your interests. That's how you get those double-digit increases in time spent.
Makes sense. And what about the generative AI side, the stuff people are actively using, like creating images?
That's taking off, too. Usage of Meta AI keeps growing. People have apparently created over 20 billion images using their tools.
20 billion, that's a lot of generated images.
It is, and it's accelerating. They launched a feature called Vibes within Meta AI back in September, and since then, media generation in the app shot up more than tenfold.
Tenfold. Wow. So people are definitely playing with these tools.
Seems like it. It suggests they might have found some early product market fit there, at least on the consumer side.
Okay, so engagement is up, generative AI is growing. Let's talk monetization again. How is AI helping them make more money from the ads?
This is where the internal AI work really pays off. They're getting big gains by consolidating their models, using fewer but much larger ad ranking models.
Right. They mentioned adopting something called Lattice.
Yes, Lattice. The CFO called it their unified model architecture. Rolling that out for app ads apparently boosted conversions by almost 3%.
Okay, hold on. Unified model architecture. What does that actually mean for someone who doesn't, live and breathe machine learning? How does Lattice get that 3% gain? Is it just faster?
Good question. It's more than just speed. Think of it like, okay, imagine before they had, say, 100 different specialized tools. One tool just for video ads, another just for photo ads. Yeah. Maybe one just for travel advertisers.
Right. Lots of specific tools.
Right. Lattice is like taking the best bits of dozens of those specialized tools and building them into one giant, super smart, general-purpose engine.
Ah.
By using this unified approach, they can train one enormous model on way more data, covering everything all at once. It learns faster, spots patterns across different ad types, and just gets more efficient. Hence, that 3% conversion lift. It's about generalization and scale.
That drive for efficiency seems like a big theme. They've cut, 100 ad models since last year?
Around 100, yeah. And the plan is to cut another 200 over the next few years. They're definitely consolidating, clearing the decks to build bigger and better.
And are there other specific examples of AI boosting ad performance?
Yeah, they mentioned improvements to Andromeda. That apparently drove a 14% increase in ad quality on Facebook.
Andromeda. Another system name. Can you quickly unpack that one? Something about retrieval and ranking.
Sure. So when you load your feed, billions of ads could potentially be shown to you. Andromeda helps pick the right one. First, retrieval models quickly grab a relevant subset, maybe the top 1,000 possibilities.
The first cut.
Exactly. Then ranking models do the really detailed analysis on those 1,000, figuring out which one you're most likely to click, considering the advertiser's bid, the ad's quality, etc., to pick the single best one for that specific moment. Andromeda improves how those two steps work together.
Making the whole process faster and smarter at finding the most relevant ad.
Basically, yes. Leading to that 14% quality jump. Higher quality usually means better results for advertisers and a better experience for users.
And all these constant tweaks and improvements feed into their automated ad products, right? The Advantage Plus suite.
Absolutely critical. The CFO said the annual run rate of revenue flowing through those fully automated end-to-end solutions has hit $60 billion.
$60 billion. That's huge. It suggests advertisers are really trusting the AI to just run their campaigns for them.
It certainly implies a high degree of trust and presumably strong performance from those automated tools.
And quickly, business messaging. Any updates there?
Still growing fast. Click to WhatsApp ad revenue is up 60% year over year in Q3. And they're testing business AI tools in places like the Philippines and Mexico, seeing millions of conversations already. It looks like a promising channel, especially for smaller businesses.
Okay, so core business. Healthy, growing, increasingly AI-powered, engagement up, monetization improving. Now, the cost of the future? Let's touch on Reality Labs first. Revenue was up 74% to $470 million, but there was a caveat there.
A big one. The CFO was quite clear that a chunk of that growth was basically retailers buying Quest headsets in Q3 to stock up for the holidays.
Pulling sales forward.
Exactly. Which means Q4 guidance is actually facing a headwind because of that timing shift. Plus, they're comparing this Q4 against last year's Q4 when they launched the Quest 3S, and there's no new major headset this year.
So even though AI glasses might do well, the Quest comparison will drag down the overall RL number in Q4.
That's the expectation, yes. The glasses revenue won't be enough to offset the Quest headwinds.
Okay, now for the really big numbers. The CapEx. They raised the 2025 outlook again.
They did. Up to $70 billion to $72 billion for this year. That's at least $4 billion higher at the low end than they were guiding before. It's just a staggering amount of money for infrastructure.
One of the biggest capital expenditure budgets anywhere, period.
Easily. But the real shocker, I think, wasn't just the 2025 number. It was the commentary on 2026.
What did they say?
The CFO basically said their compute needs have grown meaningfully beyond even these massive 2025 plans. And the current expectation is that the dollar growth in CapEx in 2026 will be notably larger than the dollar growth in 2025.
Wait, let that sink in. They spend maybe $70-odd billion in 2025. And the increase in spending in 2026 is expected to be bigger than the increase that got them to $70 billion this year?
That's how it reads. It implies potentially heading towards what, $80 billion, $90 billion, maybe even more in 2026 CapEx. It's an absolutely massive, sustained commitment to building out their own AI infrastructure, data centers, custom chips, the works.
An all-in bet, basically.
It looks like it. And of course, that huge infrastructure spending flows straight through to operating expenses later on.
Right, through depreciation and operational costs.
Exactly. So total expenses in 2026 are expected to grow at a significantly faster percentage rate than even the rapid growth we're seeing in 2025. It's driven by those infrastructure costs hitting the P&L, depreciation, power, cooling, plus the full-year impact of all the expensive AI talent hired in 2025, plus more hiring.
So costs are set to accelerate significantly just as they're making this giant capital investment. That naturally brings up risk.
Did the CFO talk about external risks that could derail this?
Yes, explicitly mention regulatory headwinds. They're talking with the EU about offering less personalized ads, which he warned could significantly hit European revenue, potentially as soon as Q4 this year.
Wow, that's near term. Very. And then separately, in the U.S., there are trials related to youth safety scheduled for 2026 that could, in his words, result in a material loss.
Okay, so they're launching this incredibly expensive multi-year investment plan while facing potentially huge near-term financial hits from regulators. That's quite the backdrop.
It certainly paints a complex picture.
Yeah.
Massive spending, significant external threats lining up.
Okay, so let's try and synthesize this for you, the listener. What we're seeing is a company that right now has its core business running like a well-oiled machine. AI is clearly boosting engagement, boosting ad prices, driving that huge $60 billion advantage plus run rate. They are making AI pay today.
But the strategy demands this absolutely enormous front-loaded investment in compute power. We're talking tens and tens of billions a year, for years, to build the infrastructure they believe they need for the next era of AI. So the whole financial story is defined by this tension. Keep the current profit machine humming versus swallowing these gigantic costs for the future.
Absolutely. Which leaves us with a final thought for you to chew on as you watch this play out. You've got this massive accelerating spending plan for 2026 and beyond. You've also got these serious legal and regulatory clouds gathering. What's the bigger risk to pulling off this multi-billion-dollar strategy? Is it that they overshoot, build way more compute than they actually end up needing? Or is it that one of these external factors, the EU ruling the US trials, lands a bigger financial blow than expected, making it harder to actually pay for that future infrastructure?
Yeah, that's the multi-billion-dollar question, isn't it? Core
Okay,
building versus external shocks.
something to think about. We'll leave it there for this deep dive.